Bitcoin just printed $63,582, down another 1% in the last hour. All 4 timeframes, monthly, weekly, daily, even the 5-hour, are flashing strong sell. The crowd is terrified. The headlines are screaming record ETF outflows. But here's what nobody is telling you. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade today. The conservative setup, the active trader play, and the aggressive high-risk strike that could return 5 to 1 if this coil finally snaps. You don't want to miss this. Here's the verdict. This is a range-bound market coiling for an explosion, but the path of least resistance is still down until proven otherwise. The invalidation level that flips everything? $$65,000 on a daily close. Write this number down. If we break and hold above $65,000 today, the entire bearish structure resets and we are targeting $67,000 plus, but right now, price is trading below every single major moving average. MA5 at $64,023, MA10 at $63,978, MA20 at $65,653, MA50 at $69,093. The 200-day is all the way up at $78,532. That's a $15,000 gap. This is what a bearish stacked moving average setup looks like. The herd is short. Retail sentiment is at extreme fear. The fear and greed index is sitting at 23, which is extreme fear territory. Here's why that matters. When everyone's already short, who's left to sell? The problem is, there's nobody left to buy either. ETF flows just recorded their largest 30-day outflow in history, $6.35 billion leaving US spot Bitcoin funds. That's institutional money walking out the door. BlackRock's IBIT and Fidelity's FBTC saw the heaviest redemptions. So we've got a market that's oversold on sentiment but still bleeding institutional capital. That's a tension setup, and tension always resolves with violence. Let me walk you through the chart from the top down, because the structural story here is everything. On the weekly time frame, Bitcoin is literally sitting on its 200-week simple moving average, a level that has acted as structural support in 2019 and 2022 before major rallies. The last time we touched this level, we consolidated for months between July 2022 and October 2023, then rallied from $27,000 to $73,000. I'm not saying that repeats, but I am saying this level matters. The CVDD indicator, cumulative value days destroyed, just hit 0.3, a level that historically preceded rebounds in 2019 and 2022. That's a long-term value signal flashing cheap. But here's the problem. Momentum is still bearish. The weekly MACD is deeply negative at -2,265.9. That's not a reversal signal, that's a trend confirmation. RSI at 38.6 is oversold but not extreme enough to guarantee a bounce. On the daily, we've got a classic bearish structure, price below all major moving averages, making lower highs since October 2025 when we peaked near $126,000. That's a 6-month downtrend of lower highs and lower lows. The daily MACD is still negative, and the ADX at 26.6 tells us the trend is present but not overwhelming. We are in a weakening trend environment. Now drop to the 4-hour. This is where it gets interesting. Price is compressed inside a tightening range. The 4H200 SMA is sitting higher up the curve at approximately $66,000. We are trading well below it. But look at the 1-hour chart. We are seeing extreme compression tightly wedged between minor support at $63,000 and the 50-hour SMA at $63,750. Here's what most traders miss. The 1-hour MACD is showing a hidden bearish divergence. Price made a higher low, but momentum made a lower low. That's exhaustion, not accumulation. Buyers are stepping in near $63,500. We've seen that multiple times now, but they're not pushing price higher with conviction. The key support levels are clear. S1, $63,553. Current price is hovering right here. S2, $62,800. S3, $62,403. The resistance levels are $1, $64,703. R2, $65 $101.03, $65 $854. The pivot point sits at $63,950, and right now we are trading below it. That's bearish buyer's confirmation. Here's the retention bridge. The next signal changes everything, and it's coming from the on-chain data that most retail traders never see. Let's connect the dots on what's actually driving this price action. The Fed is the 800-pound gorilla in this room. On June 17th, new Fed Chair Kevin Warsh delivered his first FOMC statement, and it was a game-changer. Rates held at 3.50% to 3.75%, but the statement was slashed from 300-plus words to just 130. Forward guidance? Deleted entirely. The dot plot shows 9 of 18 officials now expect at least one rate hike this year, with the median forecast at 3.8%. That's a hawkish pivot that caught the market off guard. The immediate impact? The DXY dollar index surged to its highest level since May 2025. Higher rates tighten liquidity, and that's bearish for risk assets. Bitcoin, gold, tech stocks, all of them got hit. But here's the cross-asset twist. Bitcoin is trading like a risk asset shadow of the Nasdaq, but it's also showing signs of decoupling. While the Fed hawkishness crushed BTC, on-chain data tells a different story. Centralized exchanges recorded a net buy of $234.75 million over the past 7 days. That's demand. Real, actual buying. But US investors? They recorded a sell net flow of roughly $226.84 million. So we've got global buyers accumulating while US institutional money is heading for the exits. The 1 to 2 week directional lean? Range-bound with downward bias until we see a daily close above $65,000. The event that invalidates this? A soft CPI print or dovish Fed speak that reverses the hawkish repricing. But Warsh just signaled he's not backing down, so don't hold your breath. Second interaction trigger. Do you think Bitcoin breaks $65,000 this week? Comment yes or no. I'm tracking consensus and I'll share the results in the next video. Most people skip this section. That's exactly where the money is made. Keep watching. I'm giving you 3 distinct strategies. Each one has a different risk profile, different time horizon, and different capital requirements. Choose the one that fits your style, but whatever you do, have a plan before you enter. Strategy 1, the sniper, conservative. This is for traders who want high probability, low stress setups. We are not chasing. We are waiting for price to come to our level, the trigger condition. Price holds above $63,000 and prints a bullish 4-hour candle close, meaning a close above the open with strong buying volume. I want to see the 1-hour RSI come out of oversold, below 30, and cross back above 35. That's momentum confirmation. The entry, $63,200 to $63,500 zone on a 4-hour close above the low of the rejection wick. Stop loss, below $62,300. That's below the S3 support level at $62,403 with a buffer. If we break below $62,300, the entire structure collapses and we are heading to $60,000. Target 1, $64,700. That's the R1 resistance level. Take partial profits here. Target 2, $65,800. That's above a 3. Trail your stop to break even after target 1 hits. Risk reward. Approximately 1:2.8 are from entry at $63,350 to target 1 at $64,700, with stop at $62,300. At what voids this setup entirely? A daily close below $62,000. If that happens, the bullish scenario is dead and we are looking at a retest of $60,000 support. Strategy 1, the sniper, conservative, entry, $63,200 to $63,500, 4H bullish close, stop loss, $62,300 take profit 1, $64,700 take profit 2, $65,800 risk, reward, 1:2.8 invalidation, daily close below. $62,000 strategy 2, the active trader, standard. This is for traders who want to be in the market and manage the position actively. We are trading the range, buying support, selling resistance. The entry condition. Price pulls back to the $63,000 to $63,300 zone, the lower boundary of the current range. I want to see a 1-hour bullish engulfing candle or a hammer pattern with a long lower wick confirming rejection of lower prices. Entry on the close of that confirmation candle's stop-loss placement. Below $62,000, that's below the recent swing low. This gives the trade room to breathe while keeping risk defined. The reasoning: the $63,000 zone has been tested multiple times and held. Each test has produced a bounce. We are playing the range until it breaks. Target 1, $64,500, take 50% off here and move stop to break even. Target 2, $65,300, let the remaining position run. If price breaks $65,000 with volume, we could see a fast move to $65,800. Trailing stop rule. Once target 1 is hit and stop is moved to break even, trail stop below each new 4-hour swing low. This lets you capture extended moves without giving back profits. Risk reward. Approximately 1:1.7 R to target 1, 1:2.5 R to target 2. Strategy 2. The active trader, standard, entry, $63,000 to $63,300, 1H bullish engulfing, stop loss, $62,000, take profit 1. $64,500, 50% off, move stop to BE, take profit 2. $65,300 risk, reward. 1:1.7 R to TP1, 1:2.5 R to TP2. Invalidation. For H close below $62,000 interaction cliff, type your BTC range 4. Tomorrow in the comments now, let's see who's aligned with the data. Strategy 3. The aggressor, high risk. This is for traders who can lose small and manage risk aggressively. We are counter-trend trading, fading the move at extreme levels. The trigger, price spikes down to $62,000 to $62,400, the S2 or S3 support zone. This is a liquidity grab below the recent range low. I want to see a V-shaped reversal on the 15-minute chart with strong volume, a hammer or pin bar with a long lower wick. The entry, on the 15-minute close above the high of the reversal candle, aggressive entry at approximately $62,500. Stop loss, below $61,500, tight stop, 1% risk. This is a high-risk, high-reward play. If we are wrong, we are out fast. The reasoning: if price sweeps the lows and reverses, it's a classic stop hunt. Retail stops get taken out, then smart money buys the dip. This is where the biggest moves happen. Target 1, $64,000, fast move back into the range. Take 50% here. Target 2, $65,000. If momentum continues, let it run to the range high. Risk reward. Approximately 1:3 R to target 1, 1:5 R to target 2. Explicit warning. Only for those who can lose small and manage risk aggressively. This is a counter-trend trade. The trend is down, so the probability is lower. Size accordingly. No more than 0.5% risk if you're doing this. Strategy 3. Entry, $62,500, 15 minutes V reversal close, stop loss, $61,500. Take profit 1, $64,000, 50% off, take profit 2. $65,000 risk, reward. 1:3 R to TP1, 1:5 R2. TP2 invalidation. 1H close below $61,500. Never risk more than 1 to 2% per trade. No positions through high impact news. And with Warsh at the helm, every Fed speech is high impact now. Stops are non-negotiable. You set them, you keep them, you don't move them wider out of fear. This is how you survive to trade the next big move. Remember, the goal isn't to be right, it's to be profitable when you're right and lose small when you're wrong. Let me summarize the single most critical level for the next session. $63,500. Above it, we are in the range. Buy the dips, sell the rips. Below it on a daily close, we are breaking down to $62,000 and potentially $60,000. This level is the line in the sand. Tomorrow's focus. Keep an eye on US dollar strength and any Fed speakers who might walk back or reinforce Warsh's hawkish stance. That's the wild card that could break this range. Now here's what I want you to do. If you want the full breakdown on gold and the S&P divergence from today's session, that video is live now. tap the end screen, smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one.